Muchas gracias, Guillermo. Doy la palabra a Craig LAZZARA de Standard & Poor's.
Thank you. Thanks to all of you for being with us. Guillermo is certainly correct that Friday afternoon of a two-day conference, especially in a place as nice as Cartagena, is a tough environment for the speakers, and even worse, I think, for the listeners. So thanks to all of you for being here. Especially, of course, I apologize for speaking in English, but you don't want to hear me try to speak Spanish. I can assure you of that. We're going to talk about indices and benchmarking. And I think to set the stage, here we go. I do it this way as we speak about the nature of indexing. The first thing to say about indexing is that I said here on the slide, it's a seasoned technology. Now, seasoned in English is a nice way to say old. And the older I get, the more I look for nice ways to say old. So it's a seasoned technology, been around for, well, the Dow Jones Industrial Average, for example, is 120 years old. So it's been around for quite a while. Very often indices were started by stock exchanges or journalists as a way of summarizing what was going on in the market. They're obviously a kind of a shorthand for the performance of the market, and they have two main purposes today, as they have had for the last 40 or 50 years. The first one is informational, as a benchmark for actively managed portfolios, and the second, more recently, with the growth of index mutual funds and ETFs, is actually as the basis for a passive portfolio. Those two things are entwined very importantly, because if it were not the case that index funds offered a performance advantage relative to active management, no one would care about using them as benchmarks. It's their performance that makes them relevant as standards against which portfolios can be judged. So I'll outline what I want to say really under three headings. One, I want to tell you a little bit about S&P Dow Jones indices, not really about ourselves, although we're happy to talk about it for those of you who would like to. Not really about ourselves, but to show you a little bit about the history of the index business and how our company has fit into it. Secondly, I want to suggest some answers to the question of why did indexing grow? Why has it become as prominent as it is now? And finally, to suggest, most importantly, for those of you who are potential users of index benchmarks, why I think that growth will continue. And then we can go from there. So a little bit about the history of indexing. We start out about 120 years ago. The Dow Jones Industrial Average started then. We just celebrated the 120th anniversary a few months ago. It was originally a 12-stock portfolio. It was price-weighted, meaning a stock with a $20 price was half as important as a stock with a $40 price. It's about the oldest index still in regular use and still gets lots of attention. Cap-weighted indices, and I'll come to capitalization weighting in a moment, capitalization-weighted indices started out in 1923 with a predecessor of, well, what's now called S&P Global, was then Standard & Poor's, and originally Standard Statistics, had a 233, I don't know why 233, it's an odd number to choose, but 233 stock capitalization-weighted index. Now, capitalization weighting is very different from price weighting. And capitalization weighting, the importance of a stock in the index is proportional to the total value of all of its shares outstanding. In 1923, that was very hard to compute, so there was a 90-stock version that came out daily. The 223-stock version only came out every week. And then in 1957, that 90-stock version was ultimately replaced by a 500-stock version, which we now know and love as the S&P 500. But that's a little bit about the history. Now, I mentioned the importance of capitalization weighting. And although I, like Guillermo, and I'm sure like Ramon as well, I am an advocate for smart beta investing, for factor index investing, it's important to stop for a moment and ponder the question, why is it that capitalization weighted indices like the S&P 500 or the Russell 1000 or MSCI EAFE, why is it that all those indices are as important as they are in both in analysis of performance and in terms of attracting assets? And there are really three reasons. One is that a cap-weighted index tells you the performance of the average investor weighted by the amount of capital he controls. And that's the way they're computed, and no other index will do that. The second advantage that cap weighting, or the important feature of cap weighting, I should say, is that it can be held by everyone. be held by everyone. If I want to tilt toward low volatility, someone else has to have a tilt toward high volatility. If I want to tilt toward growth, someone else has to tilt toward value. If I want a slice of everything, I can do it I don't need anyone else's permission or anyone to trade with. So no other portfolio, again, has that characteristic other than a cap-weighted portfolio. And finally, cap-weighted indices are cheap and easy to maintain. If a stock is 2% of the index and it's 2% of your portfolio and the stock doubles, it's going to be 4% of your portfolio. You only have to change the portfolio when the index itself changes. Again, smart beta or factor indices don't work that way, for a good reason, but they don't. So a few words then in favor about cap weighting. S&P itself has grown dramatically. Offices in a number of countries. My colleague Manuel is here, based in Mexico City, and Erica. We cover the Latin American region from here. The most important thing about our growth, and I'll leave you with this comment about history, is the assets tracking the S&P 500. This is, I think, the most tracked index in the world. Roughly 2 trillion, 2.2 trillion, I think at last count, of indexes of assets in S&P 500 index trackers. And that understates the total amount, of course, because the stocks in the S&P 500 are also in the Russell 1000. There's a lot of money indexed to that as well, and MSCI US. So roughly, in this case, 10% of the value of the S&P 500 is invested in S&P 500 trackers, and that, as I say, understates the case. Now, why? Why is that? Why did indexing get to be that big? And the answer to that question lies in an observation, and after I make the observation, I'll try to tell you why I think it is. The observation comes from data like this, and these data come from a report that we call SPIVA. I can only do air quotes with one hand now. SPIVA, which stands for S&P Index versus Active. And this is a study we've done for 12 or 13 years in the U.S., other regions as well, although with less time history. And what we do is to measure the performance of a category of, in this case, mutual funds. You can do other categories of assets as well. But compare the performance of, say, large-cap U.S. mutual funds to the S&P 500, or compare mid-cap funds to the S&P mid-cap 400, and so forth, and ask a number of questions, the most important of which is, does this fund, how many funds, outperform the S&P 500? And the answer, as you see on the slide here, is that most of the time, the majority of funds underperform an unmanaged index of 500 stocks. That's true across cap ranges, across geographies. This is the U.S. I say we have the most history there. We have SPIVA reports all over the world, and the result, I don't want to go through all the small print, but the result is the same. Most active managers fail most of the time. If by fail, I mean fail to outperform the cap-weighted index against which they are being compared. Now, very often, active managers will say, well, the reason you hire an active manager is not performance per se, but it's in order to manage in bad years. So in tough times, active managers can raise cash or make their portfolios less aggressive and somehow otherwise reduce the impact of a bad market. So what we did in this slide was to look at the SPIVA data and split them up into good years and bad years. Good years meaning years when the market's up by a fair amount, bad years when the market is down. And as you can see from the slide, on average, in the good years, about 60% of funds underperform, and in the bad years, about 60% of the funds underperform. So there's no hope for the active managers simply from looking at returns in different market cycles. If you think you found an active manager who can outperform, that's good. But the tendency, or the data show rather, that past outperformance is not a predictor of future outperformance. What these data look at, same database, is to say we go back 5 years and take all the managers who were above average 5 years ago. And then we say, okay, if they were above average 5 years ago, were they above average 4 years ago, 3 years, 2 years, 1 year? How many years in a row were they above average? And what the data say, for example, for U.S. large cap stocks, is that about 4.8% of managers were above average 4 years in a row after they were above average the first time, and the chance of flipping a coin and getting 4 heads in a row is 6.25%. So as I always tell people, your chance of picking a manager who's going to outperform 4 years in a row is about the same as your chance of throwing 4 heads in a row if you flipped a coin. Not very good, in other words. So those data all speak to the difficulties that active managers have in outperforming capitalization-weighted funds. The news is actually even worse than that for active managers. What we've shown you on this graph is a comparison of, in the red, is the S&P 500 equal weighted. In other words, not the cap weighted index where Apple is the biggest stock and then Microsoft, Google, and so forth, but the equal weighted combination of the same 500 stocks, just 1/500th in each. And as you can see over time, the equal weighted index has dramatically outperformed the cap weighted index. It has a smaller cap tilt. Guillermo mentioned quite rightly that over time small caps tend to beat large caps, and that's part of what we're seeing here. But what that means is that active managers, most of whom can't beat the S&P 500 by picking stocks, would have a very easy time of it if they only picked the same 500 stocks and had the same amount in each, but they don't do that either. So the difficulties for active management are very severe, and that's the point that I want to leave you with. And that brings us to the question of, well, why do people benchmark against cap-weighted indices? Simply because of these performance difficulties. You can easily buy an index fund. Why would you hire an active manager unless he could outperform? So these are historical data, and I want to spend the rest of our time speaking about the question of, will index growth continue? Now, obviously, I wouldn't pose the question that way if I didn't think the answer were yes, it will continue. And here's the main reason for that. There is no natural source of alpha. And by alpha, I mean not the most technical definition, but simply the tendency of a stock or the tendency of a portfolio to outperform. There is no natural source of outperformance. What that means is if we're all active investors in a market, the only way I can be above average is if someone else is below average. If this half of the room is above average, then the weighted average sum of their outperformance is exactly equal to the weighted average sum of the underperformance of the losers over there. There's no other way that active performance gets generated. This is what Professor Sharp, William Sharp of Stanford, called the arithmetic of active management. Active management is a zero-sum game. One person can win the game only if someone else loses. Now, the reason that's important is that the supply of alpha, the supply of outperformance depends upon how the losers are doing, not how the winners are doing. The more the losers underperform, the more outperformance there is for the losers. So let's talk about that notion for a moment and ask the question, how might the supply of alpha shrink? And what I'm going to pose for you is a question, or as an example. It's very stylized, I admit, a very stylized example that goes to the question of how does indexing affect the continuing supply of alpha. So we have two scenarios posed here. They're very simple. In both cases, the total market cap of a market is assumed to be about $20 billion, about the size of the U.S. market, a little smaller than that. In scenario A, we assume that 100% of the market is in the hands of active managers. So 20 trillion is actively managed, and we're going to assume there, since there's no source of winners alpha except for losers alpha, we'll assume that of the 20 trillion, 10 trillion outperforms, 10 trillion underperforms. So if we want to ask the question, what is the supply of alpha, we have to answer first the question, what is the average underperformance of the losers? And I made an assumption. In this case, I assumed it's 5%. You could assume anything. So 5% times 10 trillion, the total value of the assets that underperformed, is 500 billion, which means in scenario A, the total supply of alpha, the total supply of outperformance to the winners is about $500 billion. Now, scenario B, we change two things. The first thing is that we now provide a passive alternative. So instead of 100% being actively managed, now we assume only 90% is actively managed. 18 trillion active, 9 trillion above average, 9 trillion below average, 2 trillion in the index fund gets the average return. And now we have to answer the question, what is the average underperformance of the underperformers in scenario B? And the point I would make to you, or the contention I would make is that whatever the average underperformance of the losers is in scenario B it is not as bad as the average underperformance in scenario B. The reason it's not as bad is that presumably when a passive alternative is available, it is the least capable active managers who lose the most assets. So as money flows into the passive alternative, we assume 10% in this case, as money flows into the passive alternative, that has the effect of reducing the assets under the control of the least capable active managers, which means the underperformance of the losers is not as bad as it was before. What that means, and now, so as we have to make a numeric assumption, we said let's assume that the underperformance of the losers in scenario B is now 4%. 4% times 9 trillion is $360 billion. 10% increase, or a 10% decrease in the amount of assets actively managed has led, in this example, to about a 28% decrease in the supply of alpha. What that means is that the existence of index alternatives, of passive alternatives, makes conditions harder for the active managers who remain. So when we ask the question, will indexing continue to grow as a share of assets, or will it stabilize and shrink? Arguments like this say it will become harder, not easier, as indexing grows. The supply of losers goes down. And I put myself in that category, but the supply of bad stock pickers goes down. That makes it harder for the skilled managers who remain. Now, there's another part of the answer to that question that relies on this slide, and I'm going to talk very quickly about the notion of smart beta because Guillermo did a nice job covering it. But as you think about the evolution of indexing, in the beginning, all indexes were cap-weighted. S&P 500, MSCI, EFA. In the beginning, in this case, means 50 years ago. We're not talking about a very, very long history. But all indices and index funds were capitalization weighted. I said here that's the first generation. It's still the majority of assets, vast majority of assets. The second generation is, I call here specialized. I think of specialized as extensions down the capitalization scale. So there's a Russell 1000, Russell 2000, S&P 500, S&P 400, smaller cap indices, or subdivisions into sectors and industries. And then finally we come to the third generation, which I prefer to call factor indices. The world likes to say smart beta, so smart beta we all say, but we all hate it. Rahman will get a chance to tell you as well as Guillermo has. No one likes the term, but we all have to use it because that's what people know. Smart beta tries to do one of two things. It either gives you exposure, it's typically not cap-weighted, importantly. It gives you exposure to a factor of return, a quality with which excess returns are associated. Small size, low volatility, cheap valuation, all factors where academic research supports the notion that there's a factor premium. It delivers access to a factor or access to a pattern of returns that you otherwise would have to pay an active manager active fees to get. In that sense, I like to use the word as I did here, factor indices let you indicize active strategies. And when I say indicize, it's not actually a word in English, but when I say indicize, what I mean is to deliver in passive form a pattern of returns or access to a factor that formerly you would have had to pay active fees to get. And that is a big part of why smart beta has been and I think will continue to be successful. And now here's just a quick look at some of our own factor indices. These are all subdivision or divisions of the S&P 500. Hard to read on the slide, but the way the graph is laid out is the horizontal axis is volatility, vertical axis is absolute risk, total volatility. As you go to the upper part of the slide, the upper left, you're getting less risk and more return, higher Sharpe ratio, in other words. And so you see things like, for the last 10 years, low volatility, minimum volatility, high yield, and so forth. These are all strategies that have done particularly well in absolute terms. Doesn't mean they'll guarantee to do particularly well in future, but that's what the record has been. Now, why is that important as we think about the future of indexing? Imagine an active manager who's pursued a high yield strategy, high dividend strategy, or a low volatility strategy, charging you typical active management fees for access to that factor. What these data mean and what the existence of many indices and ETFs mean is it is possible to access that pattern of returns without paying active management fees. And that's an important part of why the other part of the answer to the question of why smart beta will, oops, back one, yes, why why indexing will grow is because of the existence of these factor indices. So what have we said? Two big things. One is that most active managers fail most of the time. What that means is that index investors typically have a performance advantage, and what that means is for users of benchmarks, benchmarking against a passive cap-weighted strategy is a legitimate and reasonable part of your fiduciary duty. It lets you access, or it lets you evaluate whether you're really gaining anything from the active managers you hire. The second thing we've said is that active management is not going to become easier, it's going to be harder. The growth of passive cap-weighted funds, the growth of factor indices will both see to that. So my time is up. I thank you so much for being with us this afternoon. And with that, Raman.